Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name is Manpreet, and welcome to the Through the Noise podcast. Now, this week, it's all about commodities. The asset class took center stage last week, and the key event, of course, was OPEC Plus's decision to cut output. Now, I thought it was a good opportunity to dig into OPEC's history a little bit, and no surprise that history is quite fascinating. OPEC as an organization is now over 60 years old, having been founded in September 1960 with just five founding members. It was Saudi Arabia, Iran, Iraq, Kuwait, and Venezuela. Membership grew, of course, to 10 by the end of the 1960s and 13 by the mid 1970s. OPEC's website, of course, has a great history page if you want to dig a little bit more into this. But today, to discuss what OPEC's decision and indeed the jump we've seen in gold prices means for investors, I'm joined by Abhilash Narayan, who's a senior investment strategist in the CIO office. So, welcome, Abhilash. And the first thing I want to talk about was that it seems like the market is still in the bad news is good news mode. Can you help our listeners understand a little bit more about why you see it that way?
Thank you, Manpreet. Yeah, absolutely. Over the past week, we've seen, weaker than expected economic data come out of US. But if you look at the market reaction, both equities and bonds have delivered positive returns. And as you alluded to it, gold has breached a psychologically important level of $2,000 per ounce. Now, if you take a step back, it seems that the central bank liquidity boost that we saw to stem the US banking crisis did to a certain degree feed the good news is bad news narrative in second half of March, as investors have started to price in Fed rate cuts in second half of the year, which obviously has driven bond yields lower, especially for the shorter maturity bonds. Now, this week's surprisingly weak global manufacturing business confidence indicators, such as PMIs, including contractionary U.S. new orders PMI, followed the surprising drop in U.S. services sector, and that obviously has turned the focus back to the risk of US recession in the next 6 to 12 months. There are also other signs of slowdown in US job market. So US job openings fell sharply, to below 10 million for the first time since May 2021. That's almost 2 years. And at the same time, we have seen OPEC Plus cut oil supply, which is likely to result in higher oil prices and hurt global consumer demand in the coming months, as the jump in oil prices is likely to act as a tax on consumers. So with US job market slowing down, combine that with elevated inflation, interest rates, we see that there could be a further headwind to corporate earnings and risk assets.
Okay, so let's dig a little bit more into gold prices. We're not Prices are not far away from previous record highs, but do you expect prices to keep rising, perhaps to even higher and a new record high?
Yes, absolutely. I mean, if you look at the gold prices, they are barely 2% away from breaking the all-time high of $2,075 per ounce, which was the peak that we saw during COVID crisis in August 2020. Now, if you look at gold's price action, it has obviously jumped about 10% since start of March. And if you go all the way back to September last year, since then gold prices have increased by around 25%. And when you look at the magnitude of price increases, it suggests that there are other drivers for gold besides the fall in US dollar and the fact that inflation adjusted yields have moved lower. It seems to me that US banking crisis in March, which briefly spilled over into Europe as well, has led to a flight of safety, and that has fed into demand for gold. Now, if we take a 6 to 12 month horizon, we do expect gold to scale a new record at around $2,100 per ounce, as US enters recession over that same period.
Okay, no, thanks. But I think one thing I find interesting, of course, is if I take a look at our FX forecasts, despite what you described on gold and what we saw from OPEC, we don't seem to necessarily expect commodity currencies to be the key winner. In fact, it's European currencies where, on a 3 and 12-month horizon, we expect the biggest upside. Can you help our listeners understand what the drivers for that relative view are?
Sure, Manpreet. Now, if you look at the absolute forecast, we expect both European and commodity currencies to rise modestly, in a backdrop of a weaker dollar. But as you rightly mentioned, we do expect euro to outperform most of the other currencies on a 3 month horizon. Now, if we dig into the view on euro, one of the big driver for a bullish euro view is the monetary policy divergence. So, relative to US, Europe arguably faces marginally higher inflationary pressures and slightly lesser growth concerns. As the much feared energy price shock to economic activity failed to materialize in Europe due to unusually mild winter. Now, this means that while we expect Fed to hike rates by 25 basis points in the upcoming meetings before going on a pause and likely cutting before end of the year, on the other hand, we expect ECB to raise rates by 50 basis points and then stay on hold till 2024. This, of course, is likely to offer euro a big relative yield advantage over the US dollar and likely to lead to its price appreciation. If we shift our focus to commodity currencies, we think that they do face two headwinds relative to the EU. So first of all, while Chinese economic growth is likely to benefit them, China's growth will arguably be less commodity intensive, as the authorities there are focused on boosting domestic consumption rather than promoting investment. And secondly, we think that the vulnerability in housing markets in developed worlds due to the tight monetary policy is likely to curtail building activity and by extension the demand for commodities. And these headwinds explain why we like commodity currencies uh, to appreciate, why we expect them to appreciate, but we expect them to underperform euro on a relative basis over the next 3 months. Nonetheless, if you're looking at currencies from a 2 to 4 week perspective, we think that the technical signals for Euro Aussie, Euro Kiwi, and even Euro CAD are likely neutral. So, we would watch out for more attractive technical signals on euro versus commodity currency pairs in the coming few weeks.
All right, and then finally, maybe just coming back to OPEC. I mean, given the surprise decision we had from them to cut oil output, does that impact your view on oil prices and energy sector equities?
Well, OPEC clearly surprised the markets over the weekend by announcing the unexpected oil production cut of around 1.65 million barrels per day, effective from May 2023. This obviously follows the production cut of around 2 million barrels per day announced in October of 2022. Now, what's really interesting about this announcement is that it was voluntary in nature, with the production cut responsibilities largely being shared among OPEC Plus members who have a strong compliance track record. So if you look at the list, it includes five of the largest OPEC Plus members, with Saudi Arabia leading the way by pledging a 500,000 barrels per day reduction. And Russia also extended its oil production cut to around 500,000 barrels per day through 2023. Now, while this does address the supply surplus in markets in light of weakening growth data in the recent time, we think that one of the key drivers for this announcement was more precautionary in nature. Saudi Arabia did call these precautionary measures aimed at supporting stability of the oil market. But the second factor which likely prompted the cut was the lack of US follow through in refilling its strategic petroleum reserves, even after oil prices fell into a range where it had earlier said that it would start the purchases. Now, in the near term, we believe that WTI oil prices could temporarily overshoot our $70 per barrel forecast of the next 3 months. But if we shift our focus to the long run, we would keep a close watch on three potential drivers. So the first one is, while the cuts have been announced, we need to see an actual follow through in terms of reduction in production volume. So that's the first thing to watch out for. Secondly, US's reaction to OPEC plus cut, particularly with respect to SPR refill purchases, is also important. And thirdly, we need to see the degree to which oil demand contracts on slowing global growth. On balance, we see OPEC plus price cuts moderately raising the upside risk to our 12-month forecast of $65 per barrel. Now, OPEC plus decision is likely to be incrementally positive in the near term to energy sector equities as well, which jumped this week in tandem with oil prices. But we have recently closed our overweight on energy sector as we are starting to see negative earnings revision come through. And that's something that we think will continue over the next few months. So, we would actually use the latest oil price rebound as an opportunity to reduce exposure to energy sector equities.
All right, good opportunity to reduce exposure. Thanks, Abhilash. Let's sort of bring the discussion to an end at that point. If I can sort of just sum up for investors, what I really took away from today's conversation was first that an allocation to gold we believe is still attractive despite prices being not far from record highs. Second, of course, as Abhilash just discussed, the oil price rebound we believe offers a good opportunity to rebalance away from energy sector equities towards more defensive equity sectors in the US and Europe. And finally, of course, while we do see an attractive 3-month opportunity to go long the euro versus commodity currencies, the shorter term technicals, of course, perhaps not quite in place from a 2 to 4 week perspective. So we're, of course, focusing more on opportunities in euro sterling, sterling Swiss franc, and Aussie CAD for the time being. So we'll end the podcast there. Thanks, Abhilash, for joining us today. And thank you, listeners, of course, for taking the time to listen to us. Wish you a great weekend ahead, and we look forward to speaking to you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.